Hi everyone, it's Jack back with another video, and today I'm going to be talking about an Israeli shipping company called ZIM Integrated Shipping Services. It's a company I've followed for quite a while. It's had a really roller coaster of a year. It's had more than $12 billion in revenue for the year, which is far higher than it's previously done. Currently has a market cap of around $2.3 billion, so that's an incredible amount higher. It's a PE ratio at the minute of 0.4, which is incredibly low for a company that's turning this amount of profit. Has around 3% of the global shipping market share. It might not seem like a lot, but it's a relatively fragmented market. Over 30,000 employees. Like I said, bizarre year. High of $91. It's right near its 52-week low now of $19-ish. Down 66% year to date. Really roller coaster of a year. And you are reading that correct. It has a dividend yield of over 100%. So I've analysed this company for a while. I want to dispel some myths. I want to talk about its most recent earnings, talk about its financials, and see what is the catch. How can this company get away with having over 100% dividend yield? And is it a buy, sell, or hold right now? ZIM is a 2021 IPO, so there's not a ton of data on this company, and the data that is available is only of the last few years when the business performed exceptionally well due to, in part, the pandemic and a lot of ramp up in shipping rates. So as you can see, these valuation metrics and financials are no joke. Gross margins of 57%, net margins of 42.7%, return on invested capital of nearly 80%, a PE ratio of 0.4 on a trailing basis, price to sales ratio of 0.18, price free cash flow of 0.36. These are some of the lowest values you'll ever see. It's very, very rare that you're ever going to see a value of 0.36 for a price free cash flow. That is obscenely low. Probably the lowest I've ever seen, if not the lowest. Return on invested capital of 80% is absolutely outstanding. Return on equity percentage of 128 is absolutely outstanding. And for this industry, net margins of 42% are absolutely outstanding. As I said, this has been a real golden year for a company like ZIM, and they have capitalised on it massively. The Q3 earnings came out recently, and the revenue was up around 3% to $3.2 billion for the quarter, which again, very tough comparisons versus 2021. Adjusted EBITDA was actually down 7%, $1.9 billion. Net income down 20%, $1.2 billion. Still, this is absolutely ridiculous compared to its market cap of $2.3 billion, so that's about 50% of the market cap in one quarter in net income alone. Operating cash flow of $1.7 billion is again down 17%. For the 9 months so far this year, revenue of $10.4 billion, that's up 43% year over year. Adjusted EBITDA is $6.6 billion, 55% year over year. Net income up 43% year over year. And operating cash flow up 27% year over year. These are obviously all excellent growth statistics, but you can see that it is definitely slowing down a little bit. Although revenue is creeping up, costs are creeping up clearly. They're not getting as strong margins as they used to, and net income is coming down. In this quarter, they revised the full year guidance to an adjusted EBITDA of 7.4 to 7.7 billion. That's roughly 3 times market cap, so that's absolutely no joke. The previous guidance was 7.8 to 8.2 billion, so you can see that the margins are being squeezed and they're definitely feeling a bit of pressure. They maintain the dividend at 2.95 per share, $354 million of dividends. That's 30% of Q3 2022 net income, and they're committed to returning capital to shareholders over the long term. Perhaps not this rate, but certainly a very excessive rate. In the last year or so, they've really had more cash flow than they know what to do with. $5 billion in cash flow from operations, just $293 million on net on capex. So they have this so far this year, $4.74 billion of free cash flow. About $3 billion of that is going on the dividend, $1.1 billion servicing debt. So while they're spending cash flow wisely, because they don't have a ton of debt on the balance sheet, cash debt ratio is about 0.67. It's something like $4 billion in debt on the balance sheet, $3 billion in cash. Both dwarf the market cap, $2.3 billion. Debt servicing seems like a sensible thing to do, and really what else can they do other than buy back shares or pay a dividend? So I'm absolutely okay with this, and I think this is a reasonable strategy to take. This is just a volume breakdown by geographic trade zone. KTEU is thousands of 20-foot equivalent units. You can see volumes are down. Volumes are coming down. They are down significantly on a year-over-year basis. Why this might not seem like a lot, 2021 was an absolutely exceptional year for this business. The growth from 2020 to 2021 was absolutely staggering, and clearly shipping rates are coming down. And that was basically because of supply chain constraints. They could charge whatever they want, and volume was very high. Now, they can't charge whatever they want, and volume is coming down. this is really the catch for this business. This is why the dividend yield is so high. This is why this company has been selling off so much. Is because shipping companies are going to come under significant pressure because the potential for a recession worldwide is high. Interest rates are going up. That should decrease economic activity, or that is the plan. Economic activity decreasing means less trade, means less need for shipping. You can see in the 20-foot equivalents are coming down significantly. That's on, while it may not seem like a lot, only 5% year over year in both cases roughly. The Pacific routes are dropping quite significantly, and this is a major source of revenue for this company, while the cross Suez is actually up, and so is the intra-Asia and the Latin America. Two of the largest sources of revenue for this company are the cross Atlantic and cross Pacific, and these are both down significantly, and the others will surely follow soon. The charter hire market also supports this. Rates and durations are dropping. You can see higher rates on the left hand side for 8,000 to 9,000 TEU. At one point you could charge around $160,000. Now it's coming right down to $80,000, and across the board for all durations and all sizes this is coming down significantly in the 50% range. I think the summary here is, with the dividend yield particularly, if it seems too good to be true, it often is. This dividend yield is wholly unsustainable. It came about because the stock price has dropped so ridiculously in value in comparison to its free cash flow, because the market is forward thinking, often around 6 months or so, and because it sees on the horizon that a global recession is not good for a global shipping company that focuses on global trade when global trade output is going to be coming down significantly. $2.3 billion market cap right now. One could argue a lot of this has been priced in with how low the price to earnings ratio is. Of course, this is on a trailing basis. On a forward basis, who knows? Analyst estimates are nowhere near caught up enough. Has this company got some room to fall? Yeah, probably. Is the dividend going to get significantly lowered? Yeah, probably. Will this be a fine business over the long term? Yeah, probably. I think this business will no doubt survive. Just had essentially an absolute bonanza of a year in 2021, and that's carried forward into 2022 and just can't carry on due to the recession. Will this company bounce back over the long term? Yeah, I'm sure they will. The capital allocation strategy is maybe a little bit questionable. They've put a bit too much stock into the dividend and not enough into investing in the business, in my opinion. I would have been quite happy with either as a shareholder throwing a load of money at me if I could get in and get out. Overall, this is a kind of cyclical industry, if you like, in the sense that when we go into recession, it will go down for sure. However, I think this can certainly be a long-term, strong business. And it's a business that I like, and it's a business that I follow, and at the right price I will be willing to buy. But right now, I can still see some pain on the horizon for this business. I see no need to really buy in and just throw away some money. So for me, it's definitely not a buy right now. However, if I was in the future, if more uncertainty, the clouds of uncertainty fade away, then I could certainly see myself buying this business because I like its fundamentals, I like its business model, and I like a lot of things about this business. Just unfortunately, I don't think it's a buy right now due to the current situation and the uncertainty on the horizon. But of course, you let me know what you think of this business. Let me know of other companies that you've seen with ridiculous dividend yields, whether that's been a red flag or they've actually paid the dividend and you've been quids in. Whatever you think, let me know down below. I'll see you again next time.